Hi, Jim Gore from THOR Investment Management. The stock market has taken on the chin the last several weeks, and part of the reason for that is there's going to be some pressures on corporate earnings from higher cost. We've talked about some of those things in the past, such as higher wages, inflation, but one of the things that's also going to increase their costs is cost for borrowing money. For the last several years, the Federal Reserve has made it easy for companies to borrow money, giving them basically the drug of low interest rates. Borrow as much money as you can cheaply and buy back shares. And that has been a wind at the back for corporate earnings. However, the wind is changing and it's going to be a wind in their face. If you look at this chart here, corporate debt right now is over 45% of GDP. We have clipped the high made earlier in 2009 and in 2001, and it's the highest level we've ever been. But what's interesting about the debt levels is a lot of that borrowing has occurred on short-term basis. Why? Because interest rates were so cheap on short-term debt. If you look at this chart, over the next 5 years, we're going to have over $4 trillion in debt coming due on corporations. Now, if they refinance that debt at 2% higher interest rates, which they are right now, that's a $80 billion hit to corporate earnings. So either the corporations are going to get hit their earnings by paying higher interest rates, or they're going to reverse the buybacks and actually sell shares in order to reduce their debt. So either way, that's going to weigh on earnings in the future, and we're starting to see that come through now on corporate earnings, and we think we're going to see that over the next 4 to 5 years as this debt has to be refinanced at much higher rates.